So, in light of the holiday season, and also just because here at the Motley Fool we love a good pun, today's theme, if you picked up on it, is stocking stuffers. Stocking stuffers generally are more inexpensive little gifts that you put in the stockings. And, they're supposed to be pretty cheap. So, Todd and I decided on this theme, and we were like, okay, well, what sort of companies should we consider here? So, I did a poll on Capital IQ, trying to find companies that were less than a share price of $5. And I came up with this list. I refined it a little bit because I didn't want any of these tiny little market cap stocks. So I did 250,000 or above in market cap. And we're looking at this list and we're like, this is kind of all coal. Did anything stand out to you, Todd, in that list of the worst of that heap of price under $5 stocks?
Yeah, I think that you and I were both looking at it going, yeah, I think that I would rather get coal than any of these in my stocking.
At least
Uh,
coal's not going to go down in value, hopefully.
right, exactly. I can always burn it if I need to.
Just to stay warm and put some light back in your life after all the losses on the rest of these stocks.
Right. I think that this is something that's really important to hammer home. We've talked about it before in the show. You know, Usually stocks get down on a price basis to these low, quote unquote, cheap levels, and people think that they're cheap. They're really not. Oftentimes, stocks have low stock prices for a reason. And, without a doubt, when we were looking through this list and seeing names like, Mankind was jumped out, these are troubled companies I don't think that I would recommend anyone wrapping and sticking under the tree or in the stocking this year.
Yeah, Mankind's trading for about $1.50 a share right now. This is a company that we've covered before, and they only continue to have more and more problems. I mean, so the backstory on them is that they developed an inhaled insulin called Afrezza, which sounded really promising, ended up not being so promising due to a number of different problems. And the story kind of only gets worse from there.
Yeah, the drug had a circuitous path toward the FDA, finally received approval last year, went on the market in February. There's a licensing deal with Sanofi, and Sanofi is the one who's out there repping it. A lot of people had high hopes for that deal because Sanofi also markets the top-selling diabetes drug Lantus. So far, though, it just hasn't happened. $5.5 million in sales through, 2.5 quarters.
And this is
Uh,
a drug that was supposed to be a blockbuster, meaning $1 billion.
Yeah, I mean the concept was pretty darn good. Allow people to no longer have to rely on injecting themselves, which is something that obviously makes some people wince, and instead be able to deliver the insulin via an inhaler that works a lot like an asthma inhaler. There were some advantages that Afrezza has, including a fast onset of action. But when push came to shove, uh, doctors have found it too onerous to try and convince insurers to pay for it and be able to I guess adhere to some of the things on the label, such as the regular lung function tests. And until it's sad. It's a sad situation because it's one of those things where the drug looked really good, but it shows you that you can have a really interesting drug, and it doesn't necessarily mean that there's a market for it. And I think in this case, they've spent tons of money in bringing this to the market and now trying to get it in front of people. And that cash is starting to run out, and you just got to wonder how long this company is going to remain around in its current form.
Yeah, I mean, the CEO recently departed. Sanofi has the option to back out, and they well might do that pretty soon.
Well, Sanofi, they're owed a lot of money by Mankind. Mankind's supposed to be eating up some form of a portion of the losses, and Mankind doesn't have the money to pay Sanofi for those losses, so they've basically just been banking them, and it's basically like a loan that they're supposed to be paying interest on. At some point, the company may look at it and say, either we're going to let Mankind go solve it, and we're just going to take all of their assets, which have been pledged as collateral, or we're just going to wash our hands of the whole thing and walk away. So yeah, that's a coal stock for 2016, not one that I would want to get underneath the tree.
I agree. Another one that I think we would both consider coal would be PDL Biopharma, which right now is trading for $3.83 a share. So again, you say, like, oh my gosh, that looks cheap. And what stands out about them is that they pay a 16.5% dividend yield, which is the highest in healthcare and really just an insane number. So at first glance, you might see that and say, wow, like this is a hidden gem right here.
Now, back in the late 90s and early 00s, when I was really involved in the sell side and doing some other things, I remember everybody was just, PDL was the thing because they had this fantastic technology, monoclonal antibody patents that were going to revolutionize how we treat various conditions. That indeed has happened. The problem is that patents only last a certain amount of time. And PDLI, basically what they did is they licensed these patents out to people like Roche. Roche made billions and billions of dollars off of this, paid a royalty back to PDLI. However, now those patents are expiring. They actually have expired, and they're just rolling through whatever's left over in inventory. And that means that the revenue that has been coming in from these royalty streams is going to start drying up. And I think that investors have to recognize that, when you see a stock that's trading at $3, $4 that has a high dividend yield, there's probably a good likelihood that that dividend yield is not sustainable.
So what looks like it might be cheap clearly is not actually a good deal. And that really is the heart of it, is when you're looking for a stock that's a bargain stock, you don't want to just look at just share price. I mean, it's almost like if you're looking to stuff your kids' stockings and you go to the dollar store and you buy a bunch of stuff for $1 that's really worth something well under that. The flip side of that, like an actual good bargain, I'm thinking maybe like Black Friday sales or something like that. Like you go out and you pay $500 for a TV that's worth $2,000, and that's not going to fit in a stocking. But still, two very different types of cheap that we're talking about here.